Talking tech. Is Silicon Valley's years-long game of musical chairs coming to an end? As economic gloom continues to grow, both established names and startups that once fought over top talent and bigger funding are now racing to cut staff as quickly as possible. But in last week's reprieve, a one-off. Is that potentially a one-off or a sign of continued frothiness? Joining us now, we've got Tom Forte, who is the D.A. Davidson Senior Research Analyst. Tom, great to have you with us as always and to get some perspective on tech. So last week, of course, on the back of the CPI print, we did see tech accelerate and the stock, it moved handedly towards the upside. However, this is still in a largely bear market for tech that we've seen.
So I think what last week illustrated is just how much rising interest rates have pressured high multiple tech stocks. Think Shopify, think Wayfair, think Amazon. On the layoff front, we wrote a white paper, Brain Drain Tech and Talent, and we looked at kind of what happened during the dot-com, dot-bomb era and what we're seeing today with companies who've had very significant pullbacks in their share price. So unfortunately, I think on the layoff front, there's still more layoffs to come.
And what does that imply about the industry? I mean, will we see an industry where the weakest players do kind of shake out here and that this is a prolonged period of that process? Or do you think it's going to be relatively brief?
The way that I think about it, Julie, is what's the depth or duration of the current challenging macroeconomic environment? So I think what we saw is in digital advertising, what was initially affecting Snap started to affect Meta platforms, and now is affecting Google and Roku. So to the extent that you see a prolonged period of economic weakness, I think you may see more companies under pressure and potentially more companies shutter their doors. It's very interesting to see what's going on in crypto finance right now and wondering to what extent you're going to see a number of companies there shut their doors as an example.
Tom, do you think big cap tech has bottomed here in terms of stock performance?
To the extent that the market's a forward-looking mechanism, I think you can make an argument, yes, it has. The argument is that the next move by the Fed is a rate hike, but a lower rate hike than we've seen, and that we're getting near the end of Fed rate hikes. And to the extent that you saw an improvement in digital advertising in the early days of the pandemic, when we saw that the economy was firming, that suggests that you may see the next move up in like a Roku as an example on an improving digital ad market.
So then the question is, how do you figure out where to look if you're trying to capture the possible coming upside, right? What criteria are you now using and have they changed at all, say in the past 6 months during this sort of more period of economic hardship that you're applying to some of these companies?
So it's made my job more exciting and more challenging and more difficult at the same time. I think I have to look at individual names on an individual basis. What's going to drive their sales and profits over the next 12 months? What I've seen is a very sustained period of pressure on e-commerce sales. It's affecting Shopify, it's affecting Amazon, it's affecting Etsy. At the same time, a prolonged period of weakness in digital advertising that, again, it's affecting Snap, it's affecting Alphabet, Meta platforms. So I think that you have to be very specific, look at the individual case. For Roku, they've secured $1 billion in upfront advertising revenue. And to the extent that when you saw a rebound in the economy, you saw a rebound in digital advertising, perhaps that upfront revenue can be the bridge to that rebound in digital advertising. That's why I think Roku's compelling here.
Tom, are the days of high growth internet, are they behind us? And at this point, where do you see kind of that next leg of growth in comparison to some other compelling industries that investors are evaluating right now?
So I've been following the space since 1996. I can't remember when I woke up and said, oh my gosh, eBay is a mature company. But over the last 12, 18 months, I woke up and said, Amazon's e-commerce business is a mature company. The good news for Amazon is cloud computing and advertising are still growing at elevated levels and have higher margin profiles than e-commerce. Now, as far as future legs of growth, I think you have to look at international expansion. I don't think the Metaverse will be the thing, but it could be a thing. Augmented reality, virtual reality, also I think important things, electronic vehicles. The good news is that technology is always advancing and moving forward. And while e-commerce might be slowing, there's other opportunities within tech that I think are going to grow quickly.
Tom, should Meta at this point just scrap the metaverse?
They shouldn't scrap the metaverse, but they should invest in the metaverse consistent with the opportunity. I think of the metaverse will be, again, a thing, not the thing. But the beauty for Meta is that it can give them an opportunity to own the hardware. What's really negatively affecting Meta right now is that Apple with the iPhone and Google with the Android operating system essentially have a duopoly. So the beauty for Meta could still be having Oculus, having hardware in an important thing, maybe not the next generational thing. And I think that's very powerful for Meta.
If certain segments within the tech companies' businesses that are mature, as long as they stay stable, it then becomes about where in the other parts of the business that you're seeing the most margin growth potential, how quickly that grows, and then additionally, how much they're willing to invest in this near-term period of time or over an extended period of time to make sure that that's actually retained and it continues to grow. So I guess on the capital expenditures front, what does that realistically look like? And should investors be comfortable with how much these companies are going to need to spend to retain those margins?
The good news for capital expenditures is that cloud computing as an industry continues to advance. Amazon's doing amazingly well. Microsoft's doing amazingly well. Alphabet's doing reasonably well. So I think that from a capital expenditure standpoint, you're still seeing advancements in cloud computing, next generation technology. At this point in time, again, we don't know if Apple's going to do a full-on electronic vehicle or just have, somewhat of an operating system, CarPlay within the vehicle, things of that nature. But I do think automation to fulfillment center levels is another example that you're going to see continued investment spending in CapEx in tech broadly.
Tom Forte, D.A. Davidson, Senior Research Analyst. Always good to see you. We'll talk to you soon.
Thank you.